We have a massive week in the stock market with a lot of big names that are reporting, as we can see on screen. However, today we are focusing on Canadian Pacific Kansas City that in fact reported last week, and as we can see, we have two buy ratings from Wall Street as well as Seeking Alpha analysts, and we can also see the stock is down nearly 8% over the last month. So is this a strong railroad company to add to the portfolio? It is in fact one that Bill Ackman, a very, very big and important hedge fund manager, does hold, as we can see here, around 11.48% of his portfolio, and we can even see that the reported price he bought isn't too far off at $79. So in today's episode, we're going to do a deep dive. Is this railroad undervalued? Should we consider adding to our portfolio? We'll do the usual analysis, looking at their top line revenue, their bottom line net income growth. We'll look at the health of the company, their total cash versus their total debt. And we'll also look at not just their dividend safety, but some very important financial metrics, the free cash flows, the net debt to EBITDA, the return on invested capital. And we'll also analyze what the institutions have been doing over the more recent quarters, and importantly, look at exactly how good or bad their latest earnings was by looking into their own investor presentation. As always, we will run this through the valuation model, getting to our own intrinsic value as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they are forecasting over the next 12 months. So let's start off with a very high level review of how the earnings were, and we can in fact see when we take a look at their top line revenue, they reported $2.61 billion. Now, yes, it is up 55.8% over the same period last year, but we have to bear in mind that Canadian Pacific did acquire Kansas City, so when we look at the investor presentation, we will strip that out to see the true increase. We also note that the earnings per share came in at 69 cents compared to 63 cents from the same quarter the previous year. So we do see that revenue was an increase to what analysts were projecting. However, they did miss on the earnings per share. So positive and essentially something just to consider. They did miss their revenue. Is that something that they are expecting over the next few quarters? We'll also look at their financial outlook as well. Over the last month, they may be down nearly 8%. However, year to date, they are up, although marginally 3%. Over the last 12 months, up 5%. When you bear in mind this doesn't include dividends reinvested, yes, you would be up slightly higher, but also note the S&P is much higher than this 1 year of 5%. Over the last 10 years, however, it is up around 158%. It is trading in the midpoint of the 52-week range with a trailing 12-month yield of 0.7% and a forward PE just under 26, which is marginally higher than the S&P 500. Now, in terms of looking at the top line revenue growth, what we want to see is increases year on year at least 3 to 7%, and what we note over the last 10 years, it has gone from 5.7 billion in December 2014 to around 9.5. Now that is some nice growth, but when we do take a look at it over the longer term, we do note it hasn't been consistent. Nonetheless, it does move in the right direction, and we will cover the topic of cyclicality shortly as well. On the bottom line, what do we see? Well, it has in fact more than doubled over the last 10 years. 1.3 billion in 2014, 2023 just under 3 billion. So we can also see, like the top line, whilst the bottom line isn't inconsistent as well, we can see over the longer term it is moving in that increasing direction. As always, we like to take a look at the balance sheet, so their health as well, total cash versus total debt. We can see that their total cash, 195 million in 2014, 383 million in their latest quarterly report. So it has increased over the longer term, but again, their cash is very inconsistent quarter on quarter, year on year. When we analyze their total debt, and we would expect for a railroad company to be very high, we can in fact see their total debt position has increased more than 3 times, from just under 5 billion in 2014 to 16.8 in that latest report. And similar to the other balances, it is fairly inconsistent, but we do know with their total debt, it has increased significantly over the period. That is something that should be of concern for dividend safety, and we will address that when also looking at their net debt to EBITDA metric too. On a growth rating, well, overall they do get a B-, as we can see here. A few points just to consider. Revenue growth year on year. Now, I don't think this is essentially very fair to point out, but 49% increase Bear in mind they did have that acquisition, and we will look at that stripped out shortly. Sector median 5.3%, so a lot better. Moving forwards though, this is quite nice to see. They are still anticipating some very strong double-digit growth, 20.7% versus the sector of 6%, and we can see with pretty much the other metrics, the EBITDA as well as the EBIT growth following the same pattern. We do want to point out though, when looking at the earnings per share, they are expecting this over the next 5 years to increase by around 14%, slightly higher than the sector median of 12%. But one thing that is essentially dragging their score down is their operating cash flow year on year is expected to be negative. And when we look at it on a forward basis, though, it is expected to be positive. So mixed when looking at the operating cash flow, what we can see historically it has been negative. Moving forwards, they are expecting it not just to be positive, but also to beat the sector median. When we draw your attention to the profitability, well, gross profit margin, we can see 52%. Which is very positive when you consider the sector median at just under 31%. The same goes for the bottom line, very strong A+ rating, 28.26, sector median coming in at just under 6%. So overall looking very positive for their profitability. As we saw though, when we take a look at their growth grade, B-, so not as strong. What we can also incorporate is their valuation grade and essentially comparing it to others in this sector. Now they get a pretty poor grade, so it shows it doesn't look like it's value for money solely when looking at a comparison. When we look at P on a non-GAAP basis, forward looking, just under 26, sector median coming in a lot lower, 18.57. And when we look at it on a GAAP basis, again, just under 27, with the sector median a lot lower. So overall, it is trading at a much higher valuation than others in this sector, but we will also cover that when we look at the valuation model itself. Now, what is always great, especially in this sector, the rail transportation, is to compare them to others, how they've performed over the longer term. We have Canadian National Railway, CSX, and Norfolk Southern, Union Pacific. A lot of these we have covered not too long ago on the channel, so do check them out. Over the last year then, including dividends reinvested, we in actual fact see the whole industry is up positive, with CP, Canadian Pacific, Kansas City the worst performing, up only 6%. When we extend it to the last 5 years, we in fact see them the second best. So zooming out, 5-year period, 92%, the second best only to FIP. When we go out even further over the last 10 years, we can in fact see it is in the middle performers, up 186%, which isn't too bad as well. Something just to consider though, that because they have performed like this over the last 10 years, over the next 10 years, it doesn't mean they will follow suit, so factor that in to your investment thesis. Now, when we look at their earnings per share, one thing that I would want to point out is when we take a look, we can in fact see quarter on quarter, it doesn't increase. What we note, in fact, due to the cyclicality, some quarters are much better than others. Forward looking though, so for the next quarter, they are expecting an increase of around 16% year on year. When we get to FQ1, so the quarter 1 in 2025, whilst they are expecting an overall increase year on year, we do note it is a drop from the previous quarter from FQ4, but we also notice the same pattern when looking in 2023 to 2024. So cyclicality does show that this essential industry and this company does have better quarters year on year. It is just something that comes with the naturalness of being in a cyclical industry. We will shortly look at the dividend safety and supporting metrics just to point that out. Now, in terms of looking at institutional ownership, we see it just over 72%. We see around 6 billion worth of sales by the institutions over the last 12 months, with a lot more buying over the same period. However, what is interesting to note, in the more recent quarter, we see a lot more selling by these institutions. So yes, over a 12-year period, more buying than selling, but in the more recent quarter, we do in fact see a lot more selling. So something just to consider, but as always, do your own due diligence and don't copy what institutions or even insiders do. Now, just to let you know as well, we have released our latest free weekly article. If you want to gain access completely free, do click on that pinned comment below. Also, just to point out, this article here where we talk about how to find undervalued stocks, it is one we get a lot of comments on day by day. This is where we look at all the resources, all the websites we use. If you want to find out, just click here and you can start reading. So now let's look at the latest Q1 earnings investor slide deck. Two things that we do want to point out. Now, on a high level, when we do look at the quarter 24 versus quarter 23, we do know, in fact, revenue of 3.5 billion is up 55%, which is very strong when you want to take a look solely at the top line without taking in any other fact. Earnings per share, well, on a diluted basis, they are in fact down -3%. When we look at it just on a core adjusted basis, it is up plus 3%. So there are also different metrics that they use. Maybe the key performance indicators from the essential industry, for example, train speed, as well as miles per day, active cars, train accidents. But the main things that we're looking at from a numerical and investor basis is just their top line as well as their earnings per share. The reason that we too keep mentioning that their top line, it does need to be taken with a pinch of salt, because yes, it is up 55% when you compare it to Canadian Pacific in quarter 1 2023, but you have to understand that in this quarter they also have that effect of Kansas City. When we look at it purely on a combined basis, which I think is what you should do, they are up only 2%, so low single digits. Whilst yes, it looks great in all of the earnings report and the slide decks talking plus 55%, do bear in mind that isn't comparing like for like, and when we do, it is up only 2%. Now, something that's very good to always look at when you're doing your own analysis, your own research, always try and look at for the next year's guidance, as well as some essential companies, they do also look and discuss the longer term growth. As we can see here for Canadian Pacific Kansas City, they're looking over the next 4 to 5 years. So what are the few things they expect? Well, the first one is high single digit revenue growth. So this quarter compared to the same quarter last year, it was only up 2%. Moving forwards, they are expecting higher single digit, and with regards to their earnings per share, they are expecting growth of double digit, which we didn't get to see this quarter. Now, there are other things, but the one thing that I do want to strip out from all of this, because we do talk about it a lot in these episodes, is the ROIC. Now, they want to return to double digit core ROIC. If you are someone that has watched these videos on Canadian Pacific, you will note when we take a look, it has dropped massively from the highs that we have seen not too long ago. But lots of positives to take away from their outlook. Yes, bear in mind that this is something they are projecting. It isn't something that is set in stone. But if they are able to hit high single-digit growth, double-digit core EPS growth, as well as double-digit ROIC, this could be a very strong company to consider, although at the right price. Now, dividend safety score 76, it does look to be safe. Market cap 76 billion is a large cap company. Now, we can see here their dividend safety was reaffirmed, so they do believe that a dividend cut is unlikely, and that does seem to be the case when taking a look at the metrics. Now, key metrics, this is essentially for those that believe we're heading into a recession. While they maintained the dividend during the 07-09 crash, they didn't increase it, but ultimately they didn't cut it. They had average growth negative 12.8%, which was pretty much what the S&P had during that period, but they did marginally underperform the S&P, negative 64, when the S&P came in at negative 55. Now, dividend growth, they haven't increased that dividend since 2020. Now, over the last 5 years, though, on average, it has increased by 9%. Over the last 20 years, by 11% year on year. We can see 0 years of consecutive increases. However, they have been paying a dividend for the last 21 without a reduction. Now, as always, dividend yield theory does state a company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of overvaluation on the yield, as well as on the forward PE, 24.7 above the 5-year rolling of 22.6. But do bear in mind, we don't look at any of these models in isolation, and we will conclude towards the end. We also note the industrial sector PE is much lower at 19.4. Now, we can look at the free cash flow payout, even though they haven't been increasing this. We always like to focus on free cash flow, as the earnings is susceptible to manipulation by management through accounting, and below 60% is my own blanket rule. Just gives me faith that management can offer those double-digit dividend increases we love to see. Now, interestingly, that isn't something that is offered by CP, but what we do note, it has been below 60% over the longer term, and in fact, 2024 at 2% expected. I would like to see some increases to the dividend, which is very low. This is a company that has a yield below 1%. Free cash flow is very important. You do look to invest in companies that increase their free cash flow year on year. We do know a lot of inconsistencies, but over the longer term, it is increasing, and 2024 is expected to be a strong year with $3.50 per share. When we look at the sales growth, now we want to see 3 to 7% as a steady, moderate line. What we know, a lot of inconsistencies, some years very strong. In fact, 2 of the last 10 years negative. This comes with it being in a cyclical industry. Some years very good with the double digits, some years not as great. In fact, 2015, we even see 1%. Now, 2023, yes, 42%, as we just mentioned. However, this is a comparison, or I would say not a fair comparison, Canadian Pacific versus Canadian Pacific Kansas City compared. Now, when we take a look at it, well, numerically, we did just cover that. This is another format. But on these shares outstanding, now, as always, what do we love? We love when companies do those share buybacks, returning that excess cash through shareholder pockets. And as we can see here, they were doing that up to 2020. Then they acquired Kansas City, and we can see these shares outstanding did increase. So we would like to see them go back to the ways where it was decreasing and they were doing those share buybacks. And then we move on to the ROIC. As we highlighted, we want to see double digit. This gives us faith that management are able to effectively allocate their capital. Now, they did that up to 2020. As we saw on their outlook, they are expecting in the future over the next few years to bring this back up to double digits. Hopefully we do see that, as that will be a very strong signal to investors and make it very attractive to potential investors as well. Operating margin, we do want to see a minimum of 12%, and on the free cash flow a minimum of 5%. They absolutely smash it. However, the only thing we would say is that their margin since 2020 has started to come down, so some operational inefficiencies, but overall it is looking very healthy. Just something we would like management to continue to increase, as it's very strong when you have a company that increases not just their top line revenue but also improves on the margins. Free cash flow is looking very healthy as well, so that is a good strong signal. And the net debt to EBITDA, the earnings before the interest, tax, depreciation and amortization, signals both dividend safety as well as balance sheet strength. We want to see below 3, with these numbers being the number of years it would take the company to pay off all of their debt net of cash on hand. What I like to see is after the acquisition it was very high, it has started to come down. Yes, it is above the 3, but 2024 it is expected to come down, and the fact that it is moving in the right direction does give me faith when looking towards management. Now let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button, and don't forget to drop us your thoughts in the comments below. Now the first model we're using is the multiples valuation model. Companies in a similar sector and size with their P multiple. We have the average P multiplied by the EPS of CP, and we get an intrinsic value showing our first signal of undervaluation. Just bear in mind though, we don't look at any of these models in isolation and will conclude towards the end. Now we have the dividend discount model. We can see the yearly dividends over the period. Now we do see this as a negative. They didn't have a dividend cut. It's just that they do pay out in Canadian dollars. Hence this is some central FX currency as well incorporated. Now on a growth rate forward looking, we have gone lower than the average growth rate just to be a bit more conservative, and we get an intrinsic value. Whilst it has an undervaluation signal, it is looking more like fair value as it isn't too far off the current price. We then move on to the discounted cash flow model, where we have the free cash flow year on year. Average growth rate around 15%. Now we have gone for a 16% based on analyst estimates with the discount rate. We have also used the 2024 future free cash flows as essentially the previous year position that management are estimating. This then gives us essentially the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get an overvaluation signal, so something just to consider as we take this through to the final slide. Now the intrinsic value here is just the average of these three models, and it does arrive at $82. Don't forget you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio by clicking on that pinned comment below. And it can even be companies in your watch list, or if you just want to run through CP based on your own numbers. Now, typically, we do use a margin of safety. We do typically start with 10% and execute on that if we believe it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for CP, then essentially you would be looking at acceptable buy around that $73 mark. At around 15%, it would be around $70 or $69 to $70. Right now, though, we do believe it is trading at its intrinsic value, but as always, do let us know your thoughts. A lot of people do like this company. For me, though, when I do look at railroads, I do hold a few in the portfolio. The big ones are UNP, Union Pacific, as well as CNI, Canadian National Railway. But again, a lot of people will like this for the different reasons as well. But let us know your thoughts below. In terms of Wall Street and their forecasted price over the next 12 months, well, they see a lot of upside with this company of $102.21. They see 26% over the next year. But as always, do your own due diligence and never base your investment decisions on what Wall Street say, and always look towards other pieces of information as well. As always though, let us know your thoughts. Is CP one you're looking to add? Maybe it's on your watch list. You do believe that it is trading a little bit too high, or maybe for whatever reason you do prefer other railroads like us, who we do prefer UNP as well as CNI. As always, have a great day. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts, and as always, we'll see you all on the next one.